Welcome back to Investing Talk Podcast. We're here to help you navigate the market's most anticipated moments, cutting through the noise to get to the core insights. Today, we're zeroing in on an earnings report that's just around the corner, pulling back the curtain on a company that keeps many of our vehicles, and consequently, our daily lives, running smoothly. We're talking about the auto parts giant, AutoZone. Their next earnings report is slated for September 23rd, 2025. That's before market open, with a conference call following at 10:00 a.m. Eastern Time. Our goal for this conversation is really to break down exactly what you should be watching for. We'll look at their historical performance, recent catalysts, the bigger picture, just so you're well prepared for what's ahead. And before we dive in, if you find value in our discussions, we'd love for you to join our community. Please take a moment to subscribe, like, and maybe leave a comment. Your feedback truly helps us grow. And if you're feeling extra generous, well, consider buying us a coffee. Plus, if there's a specific company you'd like us to look into next, just drop its name in the comments below. We definitely read every one. All right, let's unpack AutoZone. When we approach an upcoming earnings report like this, the first thing many of us want to know is what are the market's expectations? For AutoZone, the consensus earnings per share, or EPS, that's basically the company's profit for each share, is hovering around $51.42 to $51.43 per share. But revenue is always the other side of that coin, isn't it? What's the outlook there?
Right. That's right. What's particularly interesting here is that while a specific consensus revenue estimate isn't as readily detailed for AutoZone as maybe for some other companies, we do know their Q3 2025 revenue was $4.46 billion. That marked a respectable 5.4% year-over-year growth. And, historically, their fourth quarter tends to be stronger than the third. So analysts will be keenly watching if that upward pace continues. This really raises an important question for investors. Can they maintain that momentum without explicit guidance? AutoZone's management is, well, notoriously tight-lipped. They typically don't provide formal quarterly guidance. However, in their prior call, leadership did express confidence, sort of generally, in generating positive retail and commercial growth. So we're not just looking at the hard numbers, we're really scrutinizing those implied signals, for clues about their future trajectory.
That lack of formal guidance, it can be a double-edged sword, can't it? On one hand, maybe it suggests management isn't prone to overpromising, but on the other, it leaves a lot of room for market interpretation. Does that make the post-earnings reaction maybe more volatile for a company like AutoZone?
It absolutely can.
Yeah.
Yeah. That sort of information vacuum often fuels outsized, maybe knee-jerk reactions post-earnings, because the market has less to anchor its expectations to, right? Puts more pressure on the actual numbers that come out and definitely the tone of the conference call. Investors have to read between the lines, which, let's be honest, isn't always straightforward.
Okay, so here's where it gets really interesting for anyone trying to understand AutoZone's recent path. When we look at their recent history, specifically the last 4 quarters, we see a bit of a mixed bag. They beat EPS expectations in Q1 and Q4 of 2024, which is great, but then they missed in Q2 and Q3 of 2025. And that Q3 miss, in particular, was by a notable $1.71 per share. Now, 2 consecutive misses, that can feel like a red flag to investors. How did the market actually react to that, and what should we really take away from this mixed performance?
Yeah, if we connect this to the bigger picture, those 2 consecutive misses in Q2 and Q3 2025 are certainly something to pay close attention to. Definitely. The Q3 miss, specifically, it led to a more subdued market reaction. We saw AutoZone stock underperform relative to the S&P 500 immediately afterward. That said, it's not all misses. This mixed bag you mentioned actually highlights a critical tension here. AutoZone's consistent ability to grow its top line, especially on the commercial side, often battles a more volatile bottom line. And that's likely due to, a tougher cost environment. The real insight here, I think, is to look beyond just the EPS headline and really dig into those underlying operational efficiencies. For example, even with those earnings challenges, we saw some truly resilient trends. Comparable store sales, that key metric showing growth at existing stores, stayed positive. It was up 3.6% year over year in Q3 2025. And importantly, their commercial segment growth actually outpaced retail.
Outpaced retail. Wow.
Yeah, driven by expanding institutional accounts and broadening their product range for the pros. We even saw gross margins expand a bit due to a better product mix and some cost control efforts. Those selling, general, and administrative expenses, the SG&A, did trend slightly higher, likely impacted by wage inflation. So while the headline misses catch your eye, these details offer a more, let's say, nuanced view. They show underlying strengths, even with some bottom-line pressures.
That's a crucial distinction, isn't it? The idea that the market might be prioritizing those EPS misses over the underlying sales strength. For you, our listener, what's maybe the most convincing argument to ease that initial investor anxiety when they see those misses? Is the commercial growth really strong enough to offset those margin pressures?
Well, it really comes down to the quality of the revenue, I'd argue. The commercial segment's outperformance is a significant positive, really significant. It signals that AutoZone isn't just, coasting on the DIY market. They're strategically pushing into the more resilient and often higher ticket professional repair market, the DIFM side. This suggests a more robust, perhaps more diversified growth engine than some might realize just looking at the headlines. And when we see gross margins expanding, even with wage inflation hitting SG&A, it tells us they are managing their product mix and pricing pretty effectively. The anxiety, I think, stems more from the rate of profit growth slowing down, but the underlying demand for their actual products and services remains quite strong. The question really is whether they can continue to effectively pass on costs and optimize operations to turn that strong top-line growth into consistent bottom-line beats again.
Okay, that analysis of their past performance certainly paints a complex picture. So now that we understand the numbers a bit better, let's pull back the curtain even further. Let's look at what's been happening on the ground that might be influencing these results. We know AutoZone is continuing its network expansion. They reached, 7,516 operational stores as of May 2025. That's significant expansion. No major acquisitions or divestitures announced recently. We did see some minor reports of congressional stock transactions, a couple of representatives selling moderate share quantities. Probably not a huge signal there. But what does this broader context from store count to market dynamics tell us about the company and its environment?
Right. While those individual congressional transactions, especially in moderate quantities, usually don't move the needle for a company of AutoZone's size, or offer, frankly, significant insider insight. What's far more impactful for the broader context is the overall health of the sector itself. And the U.S. automotive aftermarket has been remarkably resilient, really quite strong. We're seeing this powerful trend of an aging vehicle fleet across the country. People are just holding on to their cars longer. And this drives persistent demand for both DIY, do-it-yourself repairs, and DIM, the do-it-for-me segment, where professional shops buy the parts. And this resilience holds despite broader economic challenges. While inflationary headwinds and rising labor costs are affecting input prices across the sector, the leading retailers like AutoZone have generally maintained their revenue, by successfully passing on those higher input costs to consumers. It's what we call revenue integrity through pass-through pricing.
Right.
Broader retail trends suggest consumers are indeed sensitive to pricing, sure, but they continue to demand repair and maintenance services, often because they're deferring those big new auto purchases. For many, fixing the car is a necessity, not really a luxury purchase they can easily cut. Analysts are certainly noting this. They're highlighting the steady same-store sales growth, but also, cautioning of potential margin pressure, and also the leveling out of comparisons against those unusually high demand periods we saw during the pandemic. Things are normalizing. As one consensus report I saw on MarketBeat put it, something like, AutoZone continues to execute on core fundamentals, but earnings growth may slow as comps normalize and costs rise. So, a lot of the street's attention is on the sustainability of that commercial growth and any signals on, say, promotional activity, which could impact margins if competition really heats up.
That makes a lot of sense. It seems like our cars are almost like stubborn teenagers. They just refuse to get replaced easily, keeping companies like AutoZone very busy. But on that point about an aging vehicle fleet, is there maybe a saturation point? Could things like rising insurance costs or maybe stricter emissions regulations eventually push consumers away from repairing older vehicles, even for DIYers? Could that shift this landscape?
That's a perceptive question, and definitely a long-term consideration. While the trend of an aging fleet has been incredibly strong, you're right, every trend eventually faces headwinds. For now, though, the economic incentive to repair rather than replace is still very powerful. Look at new car prices and interest rates, they remain pretty high. That makes deferring new purchases a very rational choice for many households. However, you're right to point out that factors like significant regulatory changes or maybe a substantial shift in the used car market dynamics could alter that picture down the road. For now, though, the momentum remains firmly in favor of the aftermarket. The key will be watching for any signals that this core consumer behavior is starting to reverse course.
Okay, so with all this information, the mixed historical performance, the resilient market tailwinds, those persistent cost pressures, what are the potential paths forward after this upcoming earnings report? What would a bullish scenario look like for AutoZone, signaling strength? And conversely, what would signal a bearish turn, indicating maybe trouble ahead?
Okay, in a bullish case, you, as the investor, would be looking for an upside surprise on those key metrics we discussed, like comparable store sales or maybe gross margins holding up better than expected. If commercial gains significantly exceed expectations, that would be a very strong indicator. It shows their strategic focus is really delivering results. Also, a reiteration of strong capital returns, perhaps continued share buybacks, maybe even a surprise dividend increase coupled with aggressive continued store expansion plans, that would certainly excite the market. And from the macro side, favorable factors like continued low unemployment, which helps people afford repairs, that would further boost aftermarket demand. Essentially, a bullish report shows AutoZone isn't just growing, but translating that growth efficiently to the bottom line while expanding its footprint. That's the ideal. Conversely, a bearish scenario, well, that would involve a material miss on EPS or revenue. Or perhaps more importantly, cautious forward commentary from management about the coming quarters. That can spook investors.
Shrinking margins, maybe due to an inability to effectively offset wage or input inflation, would be a major concern. It is profitability directly. And weaker than expected commercial growth, signaling maybe slowing market share gains in that crucial segment, that would also be concerning. Ultimately, the key metrics to watch on the call itself will be that comparable store sales growth number and the commercial segment revenue figure. Those two will tell us a lot about the company's underlying demand momentum and its competitive position in the market right now.
Right. Given everything we've discussed then, the historical performance, the market dynamics, these potential scenarios, what's your overall feeling about AutoZone right now? What are the big takeaways for you, our listener, heading into this report next month?
From our analysis, the overall leaning is probably neutral to slightly bullish. And if I had to put a confidence score on it, maybe a 6 out of 10, the industry tailwinds like that older car park we keep mentioning and a solid U.S. jobs market are certainly supportive. They create a pretty consistent demand floor. However, those 2 consecutive EPS misses and the ongoing margin headwinds, they definitely temper short-term conviction. This doesn't look like a clear runway for aggressive growth right now. It signals maybe a more cautious approach is warranted, especially given those short-term margin pressures. The real upside potential, in my view, comes from their continued commercial expansion and their demonstrated ability for efficient cost controls. But the warnings around input cost sensitivity and those normalized growth comparisons, well, they can't be ignored. And for those considering any trading strategies around this earnings event, it's probably worth noting that implied volatility, the market's guess at how much the stock might move for AutoZone weekly options straddles, is currently elevated. This means the market is pricing in larger than average post-earnings moves. So options premiums are quite rich, quite expensive.
And why is that potent specifically for AutoZone?
Because their management is so tight-lipped, like we said. That information vacuum fuels potential dramatic shifts when the numbers finally hit. So for those with a really high conviction directional bet, you might consider long straddle or strangle positions. Those profit from a large move in either direction. Conversely, if you think the stock will stay relatively stable after the initial pop or drop, short premium spreads could be attractive, collecting that rich premium. And if you're holding shares already and just want to protect your existing position amid this volatility, options callers can offer some downside protection. But honestly, my advice would probably be to wait. Wait for the specific metrics on comparable store sales and margin progression during the conference call before making any major directional bets. Getting transparency on those key operational metrics will provide a much clearer picture than just guessing beforehand.
That's really helpful context for our listeners, especially for those maybe navigating the options market around earnings. It sounds like AutoZone is a company with strong foundational demand, definitely driven by macro trends, but also one that's actively navigating some significant operational challenges, particularly on the cost side.
Absolutely. That sums it up well. And as we think about AutoZone and the broader automotive aftermarket, it truly highlights how consumer behavior, especially in times of economic shifts where new car purchases might be deferred, can create persistent and even growing demand in unexpected places. It does raise an interesting question for the long term, though. How long can this trend of an aging vehicle fleet continue to drive this kind of growth for companies like AutoZone before maybe new car innovation or perhaps even the acceleration of electric vehicle adoption might begin to shift the landscape again? It's a fascinating interplay of short-term financials and these much bigger, longer-term societal trends.
The great thought to ponder as we look to the future. So there you have it, a comprehensive look at AutoZone's upcoming earnings report. There's certainly a lot to consider, from historical trends to macroeconomic tailwinds, and those critical numbers we'll all be watching closely. Thank you so much for joining us on Investing Talk Podcast. We really appreciate you tuning in, and we hope this conversation leaves you better informed and ready for what's next. We'll be back soon with another detailed look at the markets.